The equities market is not having a good start to 2025. Just today, the S&P 500 is down 1.6%. The Nasdaq is down almost 2%. The Treasury yields are spiking. Today's jobs report came in hotter than expected in the U.S. Non-farm payrolls surged by 256,000 in December. The unemployment rate fell by 4.1%, which is better than the previous month. And of course, non-farm payrolls grew by more than the median expectation of 155,000 jobs only. So why is the market reacting negatively to this news, and why is 2025 off to such a bad start? Chris Vermeulen is here to break down market action and talk to us about what's next. He is the chief market strategist at thetechnicaltraders.com. Welcome back to the show, Chris.
Hey,
Welcome
David.
back. Happy New Year. Thanks for being here.
Yeah, thanks for having me. Happy New Year. And yeah, let's talk markets. There's some volatility going on.
There's volatility going on. Almost every time I've had you on in the last couple of months, Chris, it's just been a very volatile quarter, and
Yeah.
the volatility is not stopping just because the calendar year stopped. The U.S. payrolls grew by 256, like I said. Like I said in the introduction, and this is a very good jobs report. This is beating expectations by 100,000, which is a significant number, and the unemployment rate is falling. So by all accounts, it shows that the economy is not slowing down maybe as fast as some people may have expected, or at least not so soon. But markets are not taking this well. Like I
Mhm.
said, S&P down 1.6%. Why just puking today? Why?
Puking. That's a very visual
It's
word.
a very technical trading
Yeah,
term.
yeah, yeah. So the markets are puking out, especially the small cap, the Russell. The little kids are puking. But looking at the charts, I mean, we look at the SP 500 here, we're seeing a big move down. This is you and I've talked about this many times, and my whole story is I used to trade just on fundamentals. I used to buy shares, trade covered calls on them, and I'd only buy companies that had quarterly earnings, quarterly growth earnings. And that was back before the tech bubble. Then the tech bubble burst, and even companies that were growing by leaps and bounds, I did everything right. I blew up my portfolio, and the prices went down. And I learned this like 24 years ago. Fundamentals, economic data to me mean absolutely nothing because you can do it all right. You can have good data just like today, strong jobs numbers, and the market goes the opposite directions. Assets and stocks sell off, even though they're growing by leaps and bounds on the books. So you really have to throw news to me. You throw news out the window when it comes to an investor trying to make money from these markets. You got to follow the price. And, we're seeing the Russell down 2.5%, NASDAQ down 1.9%. And it's kind of like almost maybe you could argue it could be buy the rumor, sell the news. But in the grand scheme of things, the market has been telling us for a little while that it's been rolling over. And the NASDAQ is a good leading indicator. We've got our NASDAQ chart here, which tells us when we've started a new uptrend and we go up, and we recently hit a 10% target, but then the market turned and the internals were telling us, hey, there's big money flowing out of this market. And the NASDAQ was the first to give this signal. And when we have red bars, you do not want to be holding stocks. I don't care what sector it is. You just want to get out of the stock market because a falling tide, a tide going down brings all boats down. It's the same with the stock market. When the trend is down of the stock market, you don't want to hold stocks. So this downward move really isn't a big shock. I do believe we're going to see the NASDAQ have another fairly decent leg to the downside and a reset going forward. And that's I think really this is the momentum is stalling out, and people are just kind of selling on this news. They're unloading positions, but I don't know if it has really to do with the economic data, the jobs number, because the technicals and the charts were already pointing to the trend and the market's breaking down. And the SP 500 is very much the same. It's got a sideways pause and it's breaking down. It's a bearish chart pattern, and the prices are playing out, as they should. And the news is kind of just noise, kind of in between there.
The lack of breadth for the stock market is something that you've been talking about on my show for quite some time, Chris. Is it finally rolling over as you expected? Keep in mind that all throughout the last couple of months, it's just higher highs, lower, and even though we've had volatility, the trend has been up. Is this the start of a longer correction? Is what I'm saying.
I think it is. So if we take a look at this kind of mixed indicator, this is the SP 500 equal weighted. So it's not tech heavy. It's the small cap stocks and it's the micro cap stocks. And if we just look at it, we can see it's gone into a huge sell off. It's got a bear flag pattern and now it's breaking down and it shows we could have the markets really collapse. And the reality is a 60-40 portfolio since the high in 2022 hasn't made any gains. You're actually at a loss over the past like 2 years. And that's telling us that the majority of stocks aren't doing very well. So I think people need to be aware. If you look at the high yield dividend stocks, like this is the SP 500 high yield dividend stocks. This is what most investors are invested in. They all hold big dividend stocks. They have dropped. They got this tight bear flag pattern. It is showing we could see a huge drop in dividend stocks. And the crazy part is the SP 500 is down like 3 or 4%. And we're seeing the dividend stocks, which are supposed to be safe havens, high yield, safe plays, they're down like 3, 4 times what the SP 500 is down. And it just goes to show money is definitely flowing out of this market. While we see the indexes going up, when you look underneath the hood, we have investors rotating out. Warren Buffett continues to load up on cash. He's liquidating positions. BlackRock is selling off, I think, lots of real estate. They're huge holders in real estate. They're selling real estate at losses. And we don't really hear much about it because I think these big players have so much weighting in it. They're just trying to get rid of real estate before the real estate bubble breaks. But I think overall, this market is not nearly as strong as people think. And I think we're going to have another sharp leg down. And the monthly chart of the SP 500, as you and I were just talking before we hopped on this call, David, is really, really important, I think, for people to understand. And I use Fibonacci extensions. It's the most powerful tool, the simplest tool to predict upside targets and pullbacks.
Yeah.
And based on the rally that we had to 2022 high down to the 2022 low, we can drag that forward to where that price is. And the SP 500 came up in December, tagged that level, and now we're starting to roll over. Now, this same chart pattern has happened on gold. It's hit 100% measured move and Bitcoin. So we have equities, gold, and Bitcoin all doing the same thing on the monthly charts. So that is a very powerful sign, a warning sign that the end may be closer than we think. And as you just mentioned, I think this could be the start of a much bigger correction. I think we could see a big pullback of potentially 15 to 25%. And then, depending if the market can hold that, we might actually see another much larger drop after that. I think this year is going to be a very tough year for investors and anyone holding equities.
We're going to get back to the big pullback of 30%, 20 to 30%, and the very tough year for 2025 in just a minute. But let me just give you a fundamental story for as a counter argument here. Can you, if you just allow me to share my screen, I'm going to show you the CME
Sure.
Fed Watch tool here. So this is what happened to the probability of a Fed cut right after today's jobs report. So now there's basically no chance of a cut by the next meeting, which is in 2 weeks. There is very small chance of a cut by March. And it just, the markets are not pricing in a rate cut until June, which is further out than what happened before today's jobs report. So I think that the markets reacted negatively to today's jobs report in the sense that the number of cuts by the Fed is now reduced per expectations. Obviously, risk assets don't like that. Risk assets want lower interest rates, not higher for longer. And so that expectation is now priced in. Therefore, we can't really get any worse news than that from a monetary policy perspective. Anyway, that's one side of the story. Let me know if you disagree here.
No, I think you've nailed it. I think strong jobs number means the economy in the Fed's eyes is still strong, which means they're not going to cut rates. And if they're going to keep rates where they are, then a lot of investors will be like, you know what, I am happy with 4.5 or 4.75% with no downside risk and a lot of people are nervous. This market is topping. A lot of people missed the rally last year because they're worried the market's topping. And if rates are going to stay up here, they're going to be like, you know what, I'll just stay in cash. I'll earn, risk-free interest for now, wait for the market to correct. And that's why the stock market is selling off, because I think people are like, get me out of risk and drop me into just a nice safe cash position for now because a lot of people are nervous. And so that is a big, the strong jobs number, while it's a strong number, as you just said, on the back end, it triggers investors to be like, hey, well, I can make 4.5% with no risk for now. And that's probably a good chunk of the selling going on today.
Yeah, let's take a look. Can you pull up a 10-year yield chart, Chris? And we'll talk about the bond market before going back to the equities.
Yeah,
So
I don't have a 10-year yield market, but we could look
I'll
at
pull it up.
TLT, which is the inverse of that.
Okay, sure.
If we take a look at TLT, this is the monthly chart, and we've got the COVID high. And I mean, I've been out of favor for the bond market for a long time, and we continue to see bonds move down. And that's simply if rates aren't going down or if rates are going up, we're going to see bonds go in the opposite direction, which is down. So people definitely are worried that rates aren't going to move, and potentially rates are want to get maybe even go up. Who knows what the Fed will do? They're super unpredictable. I mean, they have no control. All these, you just showed these percentages of what people are thinking is going to happen. If the stock market was to crash and really tank the second half of January or February, it'll be a totally different game changer. What the Fed will probably say going forward, and I find they're generally reactionary and they're delayed. This is like the first time I've really noticed the big rate cut that they did last time. That was huge. They were like front running the market, and now they're not doing it. They go from saying we're going to cut a ton to now we're not cutting at all. So that's why I don't like news and economic data. It just gets in the way, and it really messes with people's minds. The reality is we have to follow the money, follow the charts, and when you look at yields, when you look at bond prices falling, it's telling us that people right now don't have faith that the rates are going down anytime soon. It's in a downtrend, and we just have to, follow the charts.
The is this going to be a bad year for bonds? I asked it because the 10-year yield spiked today. It's been spiking pretty much since the month, and actually it's been going up ever since September. To be, if you want to take a longer term perspective,
Right.
and this is just looking like the beginning of a bear market for bonds, or actually the middle of a bear market for bonds, if you want to take, if you consider the fact that it's already gone up. But anyway, what does the chart show for the 10-year,
Yeah. So if we were to
or TLT at least?
yeah, for TLT, so I think we had a more or less a kind of a topping phase through here. And now I believe bonds are trying to put in a bottoming phase. And between those, you have a bear market and you'll eventually have a bull market. I do think bonds are getting close to a bottom. And I believe that for a few reasons. The price chart alone is a signature bottoming pattern. You don't want to really try and pick a bottom because it could go lower, but I believe it's starting to form a bottom. So over the next year, I do think the equities market, the economy, I do think it's going to weaken. We're going to see the Fed eventually start to cut rates. Bonds are going to start to move up, and then we're going to start to see it have multiple legs to the upside. I think there's going to be some really good upside in the bond market, but I don't get involved in anything until the trend is turned up, and then I hop on board and I ride the trend. I know a lot of people tried to pick a bottom over here, and they've been picking bottoms through here, and you end up with multiple years of no returns and tons of volatility. So I'll be waiting for a market reversal and an uptrend. So I think bonds will be a great play, but I think we still might be like 4, 5, 6, 8 months away, which is a lot of wasted time when you can go somewhere else to take advantage of growing your account.
All right, so bonds or equities this year, which would you prefer, stay away from? If you had to pick one or the other, asset allocation 60/40, what do you think?
If I had to pick one, I'd probably say bonds,
Hmm.
um, simply because I feel like most of the downside is done. I think the
Hmm.
economy's topping, which means rates will eventually start to get cut and bonds will go up. On the flip side, I mean, in the falling market, I trade inverse ETFs, so I would say buy an inverse ETF on the stock market to profit from the collapse because it'll fall a lot faster percentage wise or bigger then the bond market will rally. But you can also use leveraged ETFs on the bond market. So either way, I think you need to be short equities or long bonds. If you had to pick one or the other, I wouldn't do a mix of both. I think that they just neutralize each other. So you gotta pick an asset class, one that's moving, and take advantage of the trend.
So when you say, going back to equities, when you say that we're expecting a pullback of 20 to 30% this year, are you counting it from now or the high, which already happened in back in I think December?
That'll more or less be from. Let me just grab the Fibonacci retracement level. So if we were to use Fibonacci to get an idea of where that pullback should be, so typically on a healthy market correction, you'd go from the high. It will pull back somewhere around 3-8%
Oh, okay.
of
So
this
you meant 25% or 20 to 30% from the high, not from
from the
current
high, not
levels.
not from where we are. So yeah, so we're
Okay.
looking from where we are right now. It would obviously be lower. So if we were to look from where we are right now, this will be somewhere right around.
So
Uh,
I think where I was going with the whole FOMC expectations thing is that I think that from a fundamentals perspective, it's already priced in, meaning it won't go too much lower. But are the technicals refuting that kind of theory right now?
in terms of the equities market going lower.
Yeah, so I basically what I'm saying is it won't go any lower because we priced in no more rate cuts. So you can't price in fewer than no more rate cuts is what I'm saying. So therefore it's done. You can't go lower than that. But that's wrong. Is that what you're saying?
Yeah, I wouldn't base anything off what people expect. And I mean, all the news stuff and expectations
Right.
changes literally from day to day. One piece of news hits the market, and everybody suddenly, will change gears. So the markets will do what it wants to do. Nobody can really predict them. You have to be able to have a strategy to follow them. And I believe we're in this. What's happening right now in the markets is very similar to this setup that we had in 2022 before we went into a mini bear market. And I believe we're going to go back into another mini bear market. And then we're probably going to have some type of pause here, and we need to see how the market's going to react. And then we could have another leg and start, this leg down when it starts to break will be like the start of like a financial reset. That's when like inverse ETFs, that's when the pain of Wall Street and bankruptcies and job layoffs and everything will totally change. But the markets, I think the markets can pull back for sure, no problem. It doesn't matter what the economic data is. Economic data can lead or lag by 12 months. It's hit or miss. Good news is bad news. Bad news is seen as good news. It is, you really don't want to follow that kind of news for your strategy. You need to follow price and what everything's doing.
What you said that potentially, even if it pulls back to 20% from its highs, that could be the beginning of an even bigger downtrend, depending on whether or not the market supports that level. What do you mean by that?
Yeah. So if we were to look at the bigger picture, so let's jump to the monthly chart and take a look at the SP 500. So if we go and we take a look from the SP 500, so the last major super cycle that was in here, we'll use a Fibonacci retracement. So we go from the 2009 lows and we go all the way to this next major cycle high. This gives us our two downside targets from the high. So if we go from the high, we could see a market pullback about 32 to about 42%. Somewhere in there is that's the most kind of ideal pullback in the market. Now it could go a lot further, but somewhere around that 40-45 mark will be very critical for a couple of reasons. We need to break the 2022 low here, which that would pierce it, and that will put people into a feeding frenzy of like, get me out, like the bottom is broken, like, and that's usually what can signal a washout low, and then we go into a big reset. So when we look at the big picture, this isn't that bad. A 43% to 50% pullback is actually the same pullbacks that we've seen during other resets. So when we go back to the 2000 pullback, we're looking at 50% to 2008, over 50%. So it's just a typical type of market correction. People don't want to live it or go through it again, but that's the reality. When there's an unwinding event of multiple waves of manipulation in the market and QE and all that stuff, it does a lot of damage when there's unwinding. I think a good chart of that almost just shows like here in the number of job openings per employee for unemployed person. Typically when we see volatility, we see the number of job openings change. And we had the market, I believe, was topping in 2015, 2016. All the signs were there. We were kind of like right where we are right now in terms of a lot of asset classes starting to come to life and weakening. But then Trump got in and created a whole new push higher. And then the whole market was about to top just before COVID, and we were about to go off another cliff. COVID quickly reset things quickly and then took off again. And we had all kinds of stimulus. And then we put in another top, and we're seeing the number of job openings fall, which is really interesting because job openings continue to fall, yet unemployment is falling as well. So it's we have some very weird mixed signals out there. And I think it's just the scenario that's unfolding here is pointing to another big correction based on the big chart picture. You got to step way back and be like, okay, this could take a year and a half to unfold. This could take like 3 years to unfold. It depends if it's like the 2000 kind of slower unwinding. It took 3 years of falling pricing, or if it's like 2008, where it's more so a huge washout
Yeah.
crash, an event that wipes things out really quickly.
I know picking bottoms and tops is something most traders avoid because it's, not really, people can't do it consistently, but any signs you look for that can indicate a bottom. In other words, suppose it goes down 20, 30% like you're talking about now. At
Yeah.
some point, it's going to reverse, like you said. Are you looking for a washout of momentum to the downside? Are you looking for just slower trading volume? Are you looking for a certain percentage increase bounce from the bottom before you can confidently say the trend is back to the upside? Like, what do you usually look for here?
Yeah, I mean, you kind of nailed it. There's a lot of things that you typically like
I
2008, you'll eventually see a huge wave of selling volume, and so a lot, and that'll happen a little bit before the bottom. So we'll be looking for a massive spike in red volume bars. We'll be looking for the news headline to be just nothing but just pain on Wall Street and investors and bankruptcies.
mm,
We'll probably see gold bottom. Gold and miners will start to build a bottom and actually start to perform first. They did that in 2008. They bottomed 3 or 4 months before the stock market did. So that'll be an early warning sign. I'm just like what we see in gold right now. When we look at in terms of gold, if we were to we've had this big move up in gold after a multi-year pause. We had the same just before 2008. We had a multi-year pause. During this pause in gold, stocks and real estate took off. Nobody wanted boring gold. They went elsewhere. But then suddenly people got nervous and they cash out of everything else. They start to move into gold to get it out of the financial system because they're worried about currencies and banks and bankruptcies and falling stock prices. Well, we've seen that right now. So what we'll be looking for eventually is for gold to put in a bottom first and high volume and panic selling in the stock market. And that'll probably be one of our early warning signs that, hey, the bottom's getting close. When volume spikes, that means it's a herd mentality. Everybody's like blowing a fuse at the same time. They're panicking out. And we'll probably see sharp drops in a lot of stocks where there will be no liquidity. Like no one wants to buy, but
yeah.
everybody wants to sell. And so we'll have very sharp, big, long red bars on a bunch of stocks and indexes. So that'll be kind of what we're looking for. It'll be really, it's always darkest before dawn, right? So there won't be any good news, and the market will put in a strong bottom. And people will all think it's just a
Mhm.
bounce, but it'll be the bottom because the market bottoms before the
Right.
economy and for the good news.
So basically, there aren't enough bad news right now, or there isn't enough just negative sentiment right now yet. So it has to
Yeah,
get worse.
there's
Um,
there's really not much bad news.
can we even say that a rise in gold is a signal in itself for bad news? Because all throughout the year, we've seen gold in stocks. Actually, not even just this year. All throughout the last 2 years, gold and stocks have pretty much been rising in tandem to the point where I think I said this to somebody else the other day. If you didn't know the gold market at all, you look at that chart, you think it's just another risk asset, right?
Yeah,
But
yeah. Let me.
yeah, let's take a look here. I think where I'm getting at with this is, first of all, gold is no longer an indicator for hard times. Yes, true or false, and ultimately, can we see 3,000 soon?
I think it's false. I think gold is still a barometer of hard times. I
Okay.
think it's telling us inflation's here. I think it's telling us people are worried. We have to wait because it will rally now before the chaos hits, and then the chaos will hit, and we'll be like, "Oh man, gold was totally warning us again." So I believe it's a warning indicator. Yes,
Hmm.
it has been rallying like a risk-on asset, but that's what it does in this phase of the market where people are nervous of all asset classes. They're even worried to have money just sitting in a bank because we know banks can now go bankrupt. So, gold to me is kind of the ultimate safe haven if you get into physical. I mean, even holding ETFs, I'm not sure how safe, the whole financial system is. And there was that really good story I've shared on here before where when the internet went out in Canada a couple of years ago, um, I met a guy who ended up filling his car up with silver rounds with gas, and it's amazing. And this is to me is where Bitcoin and gold have this huge divide. Like, what happens? Like, we go into war where there's huge EMP and electronics go down, the internets get taken down, there's no power, whatever.
Hmm.
Like cryptocurrencies, don't have a whole lot of weighting. Whereas if you've got a couple gold rounds or silver rounds on you, you still have bargaining power. So as much as crypto has got so many uses and it's, people trade it and see it as an investment, I think when all hell breaks loose, precious metals are still that safe haven play. And I believe they're going to like show their time, and that they're kind of the one asset class that it doesn't just disappear. It can't really just get stolen digitally and all that stuff.
Okay. So when we talk about precious metals, then the outlook for gold and silver, we can do a little segment here now. Is that positive or negative for you in 2025? Given that we have a negative outlook for equities from you, and given that the gold price has been correlated so far with the S&P 500, are you expecting that correlation to hold? In other words, another bearish year for gold as well?
Yeah, so right now the stage that we're in is still favorable for precious metals, and the cycle chart that I have here shows that typically we see gold and energy stocks, both do very well as the stock market is trying to put in a peak, and we're seeing both gold and energy stocks have been on fire, trading near and at all-time highs. So because we're in this stage, this it's a long-term cycle. I believe I'm still bullish on gold. I still think gold can move higher over the next 1, 2 months and maybe even push up to 3,000. It might have one more push higher here. So I am neutral to bullish over the next 1 to 2 months for gold. I do think when the economy changes and turns and things start to sell off, I believe gold will have a pullback. And we did see it pull back about 34% in 2008. And the upside target somewhere, gold could reach to about 3,050. And if we were to have that kind of type of pullback, we could come right back down to, this 2000 mark in the next bear market phase. And that would be equivalent to what we saw in 2008 percentage wise. It'll be settling right into this last breakout. And then it'll be the kind of probably the last major opportunity to get back into gold, very similar to over here, where we go into a 3, 4, 5 year rally where gold could, go 3, 5, $10,000. Who knows how this next phase will go? So short-term gold, 1 to 2 months, I'm bullish to neutral.
Hmm.
This year, though, I do think it's going to eventually get sold into and start to sell off. And
Yeah.
the question is, when does that bottom come in? Late this year, beginning of next year? I'm not sure.
That's a scary number you drew. Okay, 2750 as a bot. I mean, are you saying it's gonna if that happens, we're looking at a complete washout of gold and erasing all the gains from 2024?
Yeah, I mean that's what the charts say. I mean that's exactly also what it did over here. It broke out and
Mm.
totally erased that fear-driven move and then took off. That's the way the markets go. It has to apply maximum pain. It has to try and shake people out. Whoever rode up, an easy measured move, it usually is going to try and get them off and take their money back before it goes again. The markets are brutal. They are not easy, and you have to understand it is always the markets are always trying to take your money
So,
because
so
it's always
for
somebody else fighting for your position, right? So you just have to understand what it can do and make sure you manage positions and go from there.
so then first quarter of 2025 is looking rough across the board, equities and precious metals. Where do we hide then?
Um, I think the dollar is a very safe play. It's a low volatility move, which means you can put more money to work or all your money to work. I like the US dollar. If we take a look at the dollar index, this is the monthly chart. It's breaking out of a multi-year base. It's starting to push higher. I do think we're going to see the dollar push quite a bit higher and get up into this 116, potentially 120 or higher. That is going to apply pressure on gold. During the last major bear markets in 2000, we saw the dollar scream higher. 2008, it screamed higher. We are making a series of higher lows, a series of higher highs. And so I think the low volatility, super boring trade, but a very strong one is to be long the dollar index at this point. And when people get nervous and liquidate and all the countries are falling apart, the US dollar index tends to move higher as a defensive play.
And okay, cash then. Are you staying in cash right now?
Right now we're in cash and we're in the dollar index. That's kind of the play because right now, as I mentioned, we go back to our charts here. We're in this transition phase, so there isn't a safe spot at the moment other than a cash or holding U.S. dollars. So that's where we are, and the dollar is starting to move up. And so if this stock market keeps falling, um, anyone who's holding equities are going to get hit pretty hard, and we definitely don't want to be holding that. So cash or the dollar is, to me, the place to be.
Good. You mentioned to me offline before the interview that there's some sort of energy divergence. Can we talk about that?
Yes. All right, let's take a look. So let's look at crude oil here, and we'll just zoom in the last little bit. So I'll drop down to the weekly chart just so we have a few more bars to clean it up. If we take a look at the weekly chart of oil, we can see that it has been trending down and to the right. It's been bouncing along this support level, trying to hold support. It's had a little bit of a rally recently. I think a lot of people were betting on falling prices. I was really hoping oil was going to break down, but instead, I think a lot of people were positioned for that. So we're seeing a bit of a short squeeze here. Shake out the shorts before it goes lower. I still think oil is going to break down below about 66 and head down to the mid 50s. So what's interesting is oil has been going down, and if we look at energy stocks, this is the same time frame, they have been going up and to the right. And so people are positioned for $200 per barrel oil. People keep talking about it. And the reality is, I don't think that's going to happen. I think the economy is starting to stall. And we really had the first major leg down in this energy space that broke one pivot low and it broke this other pivot low. And I call it, it's an impulse move. When you have one strong move that breaks through one support level and then a second support level, that's a new impulse move. It's had enough momentum to break through two support levels. Typically, the first bounce from there is kind of like where you can short it, and then it's going to start a much, much deeper correction. And this chart, why I like this the most is because it has all of these pivot lows lined up here. We've got all of these different monthly wicks that there's going to be different traders from long-term charts with all of these levels set with stops. And so as oil or the energy stocks break through these levels, it's going to trigger stop orders. And we're going to see a huge unwinding and see this whole space really collapse. And looking at the big picture of energy, typically, 2008 energy stocks were high valued, just like gold. Gold has rallied up and has been flagging up here. Well, people typically near the end of economy, there's like war, there's uncertainty. So people think oil is going to do well. We've seen oil up here several times. We're back up here again. And I think we're going to go into a huge, huge waterfall sell-off. So this to me is kind of the most exciting downside play, I feel like, buying an inverse ETF on the energy space, because I think there's going to be a lot of selling. It's going to go fast. And this is going to hurt investors, passive investors a lot, because these are a lot of dividend paying stocks. And that means their portfolios are going to get hit very hard. Dividends eventually start to get cut or eliminated, which I remember seeing in 2008. And tell you, when energy stocks start eliminating or reducing dividends, their share prices get hammered. Not only do investors want to quickly dump it, but there's so many funds and fund managers that only hold dividend paying stocks. And when the dividend yields are going down or have been eliminated, they have to get rid of them out of their funds. And it adds even more selling pressure. So this is looking forward over the next year. I think like this space is going to get hit really, really hard and do maximum damage to a lot of investors.
Are you short energy then right now?
No, not short because technically the stock market is still in an uptrend. When we look at the long-term trend here, overall, we're still in a rising environment. We're in a bullish phase. So I need to wait until we have a bearish phase. Once we're in a bearish phase, then I'll be like, okay, the on average bias is to the downside. There's more selling every day, every week, every month than there is buying. So once we get that sell signal in the markets, that's when, we'll probably be looking at, okay, we can buy an inverse ETF on something, the energy space. And as the stock market goes down, that energy sector space will probably fall like two, three times more than the stock market, if not even more than that. So you have to wait for the setup. You don't want to short when the tide is still going up. The short-term sell signal we have is that just that. It's a short-term sell signal. The stock market could turn around next week and generate another green bar, and we could get long on this chart for the QQQ, and we get back in, and there is actually 11% upside potential in the Nasdaq. And so I know this is probably confusing people, but we have to follow price. Right now, you don't want to hold stocks. But if the market hooks up and turns higher next week or over the next couple of weeks, the Nasdaq could rally 11%. But you have to wait for that buy signal to get in. Right now, holding stocks, you're holding a falling knife or trying to catch a falling knife, and you don't know how far it's going to go.
Okay. Yeah, that was a pretty grim outlook, Chris. I'm not feeling I'm not feeling great right now. But
You
let's
feel like puking, like the charts?
yeah, I mean like the markets. Um, okay. Any positive upside besides the dollar?
I think the only other thing that's somewhat positive, I think, is still the gold chart. Like, I still think it's going to do okay over the next month or two. So if we zoom into this chart and we look at the chart pattern, the trend is up, and using a Fibonacci just based on this last rally, this last leg up, and this recent pullback, there is potential for gold to stair step its way up to this level. So we could see from where we are today, we could see about a 5 to about a 12% move in gold, which brings us to that 3,050 mark. And that's just a simple stair stepping price action of the market. And that's a definition of a rising tide. I mean, there's multiple steps, right? So the trend is still up in gold. All I'm saying is the monthly chart is hit. Now I believe that any extra upside here is just a little icing on the cake. You don't short gold here. If anything, you should still be long gold. And because there's upside potential, this is a bullish chart pattern. But just know that anything here, I see it as just a free trade, icing on the cake, extra profits, and you got to be aggressive to make sure you lock in those gains. Because if it does have this blow off move up here, I do feel like it's going to eventually have a very sharp hit and go into that deeper correction throughout the rest of this year.
Okay, great. Thank you very much, Chris. Tell us where we can find your work and learn more from you.
Yeah, well, they can go to the link below in the description and visit my website where I share my trade alerts. I share pre-market videos of what's going on in the markets for gold, oil, all kinds of different sectors and all that stuff, and really just copy the ETF trades that I do. Highly educational. It's a good way to start the morning before the opening bell, be primed and ready with all the news and the momentum of all the different assets. And yeah, be able to follow the markets and pull money out no matter which way the market's going.
Okay, excellent. Link down below. Make sure to follow Chris and study more from his asset reinvesting techniques. We'll speak to you again soon, Chris. You'll be in Vancouver, right? You'll be in the Vancouver Resource Investment Conference.
I will.
So
Yep, sounds great.
I will see you in person. Our first
Perfect.
in-person interview. Look forward to that.
All right, take care.
And thank you for watching. Don't forget to like and subscribe.